Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TECHNIPFMC PLC quarterly report. TECHNIPFMC PLC offers a wide range of businesses and services across the energy sector. The company's primary offerings include subsea systems and infrastructure surface technologies for land and shallow water exploration and production drilling, and wellhead services, pressure control systems, fracturing equipment, and services flexible pipes and flowline safety and integrity systems, well control and integrity systems, skid solutions planning, testing, installation, commissioning, operations, maintenance, and decommissioning services, flowline products and services. These businesses and services cater to the oil and natural gas production and transportation needs of clients across various regions worldwide. The recent surge in TECHNIPFMC PLC's stock price can be attributed to a combination of factors. The company has consistently reported strong quarterly earnings results, exceeding analyst expectations and demonstrating its ability to deliver robust financial performance. This is evident from its Q3 2024 results, where it beat analyst estimates with revenues of $2.348 billion and net income of $274.6 million. In addition to its financial performance, TECHNIPFMC has secured several significant contract awards, including major iEPCI contracts for subsea processing and production systems. These contracts not only demonstrate the company's expertise in delivering complex projects, but also contribute to its growing backlog, which reached a record $16.8 billion in Q3 2025. The company's commitment to maximizing shareholder value is also evident from its increased share repurchases, with an additional $2 billion authorized in October 2025. This move reflects the confidence of the board of directors in the company's outlook and its ability to deliver strong returns for shareholders. Analysts have maintained a positive outlook on TECHNIPFMC, with buy or overweight ratings and price targets ranging from $41.93 to $51. The company's integrated subsea solutions, growing backlog, and strategic wins position it as a key player in the offshore energy revival, further contributing to its stock price growth. Overall, the combination of strong financial performance, significant contract awards, and shareholder-friendly actions has driven TECHNIPFMC PLC's stock price to increase significantly over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the increase in service and product revenues, with a notable surge in subsea technologies segment in Latin America, Africa, and North America. The adoption of new technologies such as Subsea 2 and CTO platform, iEPCI commercial model, and expanding reach of subsea services from an aging installed base have also contributed to revenue growth. Additionally, increasing offshore developments with higher economic returns and growing international markets in the North Sea, Asia-Pacific, and Middle East have driven revenue growth. On the other hand, revenue decline is primarily attributed to the decrease in lease revenue and surface technology segment in Latin America, Africa, and North America. Lower commodity prices affecting North American activity and completion of projects in Angola have also contributed to revenue decline. Net income and profit margins. A shift in performance. The company's net income has shown a significant increase over the past year. In the 3 months ended September 30, 2025, net income rose by 11.6% to $310.9 million compared to the same period in 2024. This trend continued for the 9-month period, with a 15.5% increase to $722.5 million. However, profit margins have not followed the same upward trajectory as net income. The net income margin decreased from 11.9% in 2024 to 11.7% in 2025 for the 3-month period. In contrast, the 9-month period saw an increase in net income margin from 9.3% to 9.8%. A closer look at segment-wise profit margins reveals a mixed picture. The subsea operating profit as a percentage of revenue increased significantly from 12.5% to 15.9% over the 9 months, while surface technologies experienced a decrease from 10.5% to 11.2% in the 3-month period. These changes suggest that the company's performance is influenced by various factors, with some segments performing better than others. The increase in net income and profit margins for certain periods indicates growth, but the mixed results across different time frames highlight areas that require attention. The company's financial performance indicates a positive trend in operating cash flow. According to the provided data, the company generated $1,311 million in operating cash flow as of September 30, 2025, and $382.1 million as of December 31, 2024. This demonstrates a significant increase in operating cash flow over time, suggesting that the company is successfully managing its finances and generating sufficient funds to support its operations. The company's financial performance has shown significant changes in its debt level and interest expenses over the past year. Notably, the company's total debt has increased by a substantial 101% from $438 million to $885.2 million. However, this increase is somewhat offset by a decrease in short-term debt from $277.9 million to $33.6 million. Furthermore, the company has made significant debt repayments of $404.7 million in the 9 months ended September 30, 2025. On the other hand, interest expenses have decreased significantly, with a reduction of $15.1 million from -$50 million to -$34.9 million. This decrease is also reflected in the net interest expense, which has reduced by $15.1 million over the same period. Overall, while the company's debt level has increased, its interest expenses have decreased, indicating some cost savings for the business. The company's financial performance has been mixed across various segments and regions. On the positive side, the subsea segment is expected to thrive, with a significant increase in revenue from $1,779,600,000 in 2025 onwards. International markets, particularly the North Sea, Asia-Pacific, and Middle East, have also performed well. In contrast, the surface technology segment has struggled, with declining revenue projected for 2025. Furthermore, North American surface activities are expected to account for only a small percentage of the company's total revenue in 2025, indicating a poor performance in this region. Management's outlook and strategy overview. The company's management has expressed a cautious outlook due to various risks and uncertainties in the oil and gas industry. However, they are optimistic about the long-term prospects of the sector, driven by anticipated growth in energy demand and a focus on technology innovation and reducing carbon emissions. To achieve this vision, the company is transforming its business through its Subsea 2 and CTO platform, which has enabled cost savings and shorter delivery times. The strategy also involves securing significant inbound orders, with a target of $10 billion over 3 years ending 2025. Management emphasizes the importance of maintaining a strong balance sheet and liquidity, while also focusing on sustainable leverage and liquidity. Additionally, the company is expanding its presence in international markets, particularly in the Middle East, where it has made substantial investments to support national oil companies' growth plans. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, the company has paid dividends in 2025 and 2024, as documented on various pages of the financial summary. Additionally, the company has also engaged in share repurchases, with amounts mentioned for 2023, 2022, 2025, and 2024 across multiple pages. Concerns about inventory buildup or supply chain disruption are present in the company's financial summary. Specifically, there is a significant order backlog in the subsea segment, $5.6749 billion for 2026, and surface technology segment, $357.7 million for 2026, indicating potential inventory buildup. Additionally, the subsea backlog has increased by $2.52 billion from December 31, 2024 to September 30, 2025, further exacerbating this concern. Meanwhile, a decrease in the surface technologies backlog of $82.8 million suggests potential supply chain disruption. These issues may impact the company's operations and profitability. That concludes the financial summary for TECHNIPFMC PLC. Feel free to comment below, and I will be happy to answer them when possible.